Here we go, everybody. We are live. Welcome to Cowboy Metals Livestream. It is Tuesday, June 14th, 2022. And I am your host, Robert Keats of 𝙎𝙄𝙇𝙍𝙍. Welcome to the program. We're going to be talking about what the Fed is expected to do tomorrow. I've got a poll up in the chat. Fed rate hike tomorrow. Do you think it's 50 basis points, 75 basis point, or does Powell engage in a grudge match with Yellen in the wrestling ring? Thank you, everybody, for joining the program. This is your host, Robert Keats, Cowboy Metals Live, where we broadcast from the great state of Texas and take no BS. Welcome, everybody, to the program. I see Helen Stryker is here. David Lopez is here. Neil's World, Mark the Silver Shark, Joseph Moss, Deeps, and others are here. Thank you, everybody, for joining the program. We're going to talk about what we think the Fed may do tomorrow in the aftermath of the absolute bloodbath that the markets have turned into, at least most of the assets on the market dating back to the beginning of the year. I've been talking about that over the last several weeks. And hi, Dale, how are you? Nice to see you here. Hi, Kenneth, thanks for joining. Hi, Derek, Mark the Silver Shark, 𝙎𝙄𝙇𝙑, Neil's World. Thank you, everybody, for joining the program. As you guys get loaded in, anyway, in continuation, the bloodbath has been really bad, with the exception of gold, silver, and probably some income-producing real estate. Other than that, the markets are selling off. It is a liquidity event and a market sell-off in a tightening cycle, and the Fed looks bound and determined to tighten no matter what, which is probably not going to be good overall for the market. So I think we can expect, regardless of what the actual rate cut is, or sorry, rate increase is tomorrow, that we're going to continue to have tightness in the markets. Punch bowl has been taken away, and that is affecting everything, of course. Thank you, everybody, for joining the program. We're going to jump right into the presentation, and we're going to start with a nice little quote from our president of these United States, Mr. Biden.
And I agree with what Chairman Powell said last week, that the number one threat is the strength, and that strength that we built is inflation threat. So the Fed should, and I agree with what Chairman Powell said last week, that the number one threat is the strength, and that strength that we built is inflation.
So according to the president, they're broadcasting what is expected to occur, inflation. They're going to inflate away the debt, which means I think that they're going to come back to overall the printing program, and they're going to ease and lower interest rates eventually. But I think that they're trying to create some space and get some interest rate cushion, if you will. And so I think they'll continue to hike throughout the year. Now, Powell and the Fed had said last year and earlier this year, moving into the tightening cycle, that they were more likely to stop the tightening if the markets came under pressure. The markets are coming under pressure. Unemployment is not great. At least the labor force participation rate is not great, but unemployment overall, the U6 number, is decent. So I think the Fed's going to continue to tighten for now. And I wanted to talk about how inflation is hitting the markets. Here is the year-over-year U.S. producer price indexes came out this week. We're at over 10%, not quite the 11% print we had 2 months ago, which would have been March numbers, but the May numbers are still almost 11%, still in the double digits. CPI is only 8.7%. I called BS on that a couple of weeks ago. I think the CPI is probably, or the real consumer price inflation is probably hovering around 20%, not the 8.3 or 8.5 range we've been in the last couple of months. But in any case, producer prices have been rising since February of 2021. Yeah, since February 2021, producer prices have been rising. So I've been claiming since last year we're going to have inflation, because I was seeing these numbers as the wholesale prices, or the producer prices, will rise first in the supply chain as they're using more raw goods and developing finished products. So we're nowhere near the end of inflation, because this inflation the producers have been going for a while. They got to pass it down the market chain, and I think we're going to continue to have it. And I don't think, with apologies to some of my good friends, that it's just the supply chain issues. Also it has to do with the monetary aggregates, and we'll talk about that a little bit later in the program. A couple of articles I wanted to share with you about what's going on in the market to explain what we're seeing The hedge funds sold stocks at the fastest pace on record, surpassing even the Lehman liquidation spree. The Lehman liquidation spree was the last recession, 2008, 2009. So they're shedding stocks even faster. This is the 5th largest sell program in history. And this is what is happening. Sell, sell, sell. Even worse than the Lehman crisis. If anybody had any question about how bad this crisis could potentially get, at least we know from a stock perspective, the hedge funds are dumping. Here is an indicator from Bank of America Global Research on whether we're at a bear market indicator or bullish market indicator. We're at the most extreme bearish that you could get according to their bull and bear indicator, which is comprised of hedge fund positioning. We just talked about hedge funds. Here's a hedge fund positioning. Of course, the hedge funds are selling out. That's about 2/3 of the index. Credit market technicals, equity market breadth, equity flows, so on and so forth. So the big banks indicator that we are in an extreme bearish sentiment in the market. It's not hard to see why. Moving on to bonds. I was on Chris's program at Arcadia Economics earlier today in a live spot talking about the 10-year Treasury and the 2-year Treasury. The 10-year is up to 3.479, the current print, as noted here at CNBC. That is the highest, I believe, in 11 years, according to a CNBC article I read earlier today. So the 10-year is not doing so hot. For those of you that hold bonds, when the rates rise, it makes your existing bonds worth less because current bond issuances give you a little bit more yield, but it's so the current bondholders lose money. That's why it's bad for bond rates to rise for existing bondholders. But what is also worse is that signaling, because the bond holders are probably smarter than the stockholders. Well, we know they're smarter than the stockholders, is that they expect the economy to get worse. So this is what I think of when I see interest rates rise on the benchmark 10-year Treasury. I see that as bond traders saying rougher times ahead. It's not over yet. Something I put out on Twitter late last night, early in the morning, I believe it was early in the morning after I woke up. I went to bed really early yesterday, was a Treasury yield curve inversion. What the yield curve inversion is, when the short-term benchmark, the 2-year, is at a higher rate than the 10-year, the long-term benchmark. We saw that as of early this morning. The 10-year was at 3.356. The 2-year was higher at 3.393. It was a very momentary yield curve inversion, but that tends to signal an oncoming recession. And the 3, 5, and 7 were also inverted, meaning they are trading at higher rates than the 10, but the benchmarks are the 2 and 10. That's why I highlighted those in red. So a momentary yield curve inversion because of the spiking interest rates on the bonds. Right now, they're not an inversion, but I do think that means more short-term risk ahead. That's what the yield curve inversion is. And that's what it signifies to the market. I'm going to talk about money here in just a moment with an article at Zero Hedge, but I wanted to check on the chat, see how you guys are doing, and do a real quick sound check. Sound is working. Welcome to the 119 people in the stream. Remember that we have a poll up. We got 60 votes so far. And the question is, what is the Fed rate hike tomorrow? 2 serious choices, 50 basis points or 75 basis points. 75 leads with 50% of the vote. And then 8% of you tongue-in-cheek are voting for Powell to have a grudge match with Yellen, which I think we would all enjoy seeing. In fact, we need to make that on live TV and open the betting lines. I think it'd be a lot of fun because those are 2 of the biggest head clowns running the financial system in the United States. Michael is here riding shotgun as channel moderator. So is Peter Frowine. Welcome to the house, both of you. Ralph Potts is here. Dale Ball is here. Joseph Ponce is here. Kevin W. is here. Thank you so much for joining the program. Charles McClendon has a question. Rob, can you discuss buying bullion versus premium coins inside a PM IRA? Premium coins, I'm going to assume, Charles, means some sort of numismatic or collectible for purposes of answering this question. I would say if you're going to have it in an IRA, it's easier to liquidate regular bullion. So I would stick with the bullion. I do like the collectibles, but I like to have those out in personal storage so that you can liquidate those when you need in the market by going to a coin show, putting them on eBay, or visiting your local coin dealer. That would be my take on that. I'm sure other people may have a take on that as well. Please feel free to include that in the chats. Remember, super chats are open. These do help the channel. Guaranteed to answer those during the channel if you guys want to do that. Welcome everybody in. I don't see any other questions. So we're going to go back to the presentation and we are going to talk about monetary aggregates. And this is really important, and I'll show you why. So there's an article at 𝙎𝙊𝙇𝙍 talking about slowing money supply growth in 2022 points to a recession. Why does that matter? Because when the Fed reduces the amount of monetary aggregates, that means there's less money sloshing around the system. And that means the economy slows. And here's a nice chart in the article. It's written by an Austrian economist from 𝙂𝙊𝙇.org. So they put in the true money supply, which is an Austrian economics measure of monetary aggregate, something that I graphed out in detail, an article I wrote on Seeking Alpha in 2011. And it's nice that they published that here for us to see. And of course, we have the M2, which is the more commonly used contemporary or Keynesian economist measure of a broad money supply in the economy. And you can see that they've both fallen off a cliff since the beginning of the year. Now, it's interesting to note, these have fallen off a cliff, basically, well, not in the beginning of the year, middle of last year, basically has led a leading indicator to what is happening in the markets. Once the monetary aggregate supply falls off, then you get crashes in the stock markets, the bond markets, the other paper derivative markets, because they depend on what? They depend on money supply, and what's happened in the money supply. Look right here, it is cratering. The money supply is cratering. Not only that, another recession indicator, surging oil prices. The last three recessions were prefaced by surging oil prices having to do with the lack of demand and storage. And there's a nice chart here. Only chart I'm going to use from this 𝙎𝙊𝙇𝙍 article is OPEC spare capacity. You can see as that spare capacity fell, it led to a recession, fell, recession, fell, recession. It's now falling again, a precipitous decline in 2021, 2022, indicating that we're probably headed toward yet another recession. Now, it can take some time before this indicator indicates a recession, but when oil prices go up, oil is such a big input into the economy that tends to lead to recessions. Again, giving you additional indicators. We talked about monetary aggregates. We talked about bonds. We talked about the stock market. We've talked about energy in the form of oil. All of the reasons why we're headed into a recession, which is why I think the Fed is behind the curve in raising their interest rates. And I think that they're going to raise interest rates again. I'm going to go back to the stream, guys, in the chat and see if you guys have questions in the chat. Remember, our poll question is up 76 votes. Most of you, or about half of you exactly, expect a 75 basis point increase. It was interesting that they were talking about a 0.5% or 50 basis point increase in the federal funds rate, basically since Powell and the Fed most recently in the last month have been addressing the press. Steve Leisman from CNBC comes out. That was discussed earlier today on Arcadia Economics with myself and Chris. He put an article up at Steve Leisman saying, should it be 75 basis points? I've read several articles from other participants in the market that also are predicting 75 basis points. I don't know what it's going to be, but if it is, that signifies a more bearish view of the market per the Fed than what even they thought a month ago. And that's probably an indicator things are a little bit worse than they're letting on if they actually come through with a 75 basis point or a 3/4 percentage point hike tomorrow. We'll see what happens. Thank you everybody for joining the chat. Remember, super chats are open, helps the channel, and guaranteed to answer your question. We now have 160 people in the stream. It is nice and healthy. Good to see all of you guys here. The Fed tomorrow is expected to announce a 75 basis point increase in the federal funds rate, which is going to further slow the economy because it reduces the amount, or it increases the capital cost of borrowing, which reduces the amount of cheap debt in the system, which tends to slow things along with everything else I've talked about, including rising inflation, including hedge funds selling stocks at the fastest pace on record, including the bull and bear indicator from Bank of America, including rising bond rates, including yield curve inversion, which we had yesterday, and I posted on Twitter as soon as I saw it early this morning, including a severe reduction in the money supply when measured either by Austrian economist version of that, the TMS, or the Keynesian economist version of M2, same thing, and higher oil prices due to lessening capacity. All of these are recession indicators. I brought you a whole bunch of them. I got you a really interesting story for you guys now. You know how we've had this great exodus from Central and South America and Mexico up into the United States over I don't know how many years? Well, now we have a reversal of that, at least as far as California is concerned, the great California exodus to Mexico. Thousands flock south of the border to escape the crippling cost of living under President Biden and Governor Gavin Newsom. Californians fleeing rising prices in the state are relocating south of the border in Mexico. The trend comes as inflation in the U.S. has sent gas and grocery prices soaring under President Joe Biden's administration. I'm reading this from the article. I'm not saying that. I'm not blaming Biden or Gavin. I'm just reading the article for those of you who support the Democrats. Don't get mad at me. This is what the article says, the 𝙎𝙊𝙇𝙀𝙍. Another bullet point, some have argued that the influx of Americans in cities south of the border has begun to price out some Mexicans. Again, this is from the article from the 𝙎𝙊𝙇𝙀𝙍. The article goes on to note, thousands of Californians are fleeing to Mexico amid the soaring cost of living in the Golden State. Americans take advantage of work from home or reaping the benefits of U.S. salaries who are living off of Mexico's cheaper lifestyle. Others are living in Mexico while commuting to work in the U.S., I assume across the border every day. But critics have argued that the influx of Americans in cities south of the border has begun to price out local Mexicans. So Americans are moving to Mexico, especially from California, bringing inflation with them, exporting it from California to Mexico, and outpricing the ability of Mexican locals to live in those cities. Are they going to come back up to Texas and California? It's going to be interesting to see how this plays out. I find this a very, very interesting article and definitely a sign of the times. Further reading from the article, it comes amid a wider exodus of Californians to other states across the U.S., including Texas, Washington, and Arizona. I would also argue in recent charts, I've seen a lot of Californians moving to Florida and New Mexico. Many feel forced out by rocketing inflation in the Golden State, so on and so forth. All right, sound check, sound looks good. Going back to the articles, not only are we having issues in the United States and California, Japan is starting to look like a train wreck. For those of you who thought we were going to follow Japan in a decades-long stagflation, I would argue it's impossible to happen because the rest of the world is in a mess also, and they can't bail out us like we all did Japan. And now nobody can bail out Japan. As the rest of the world gets worse, Japan is starting to experience problems. Their yen is tumbling, and the stocks and the bonds are tumbling also. As per Bloomberg, and the article you see here is from Bloomberg syndicated to Yahoo. With the yen, the Japanese yen at 24-year low, the article reads, Tokyo stocks down the most since March, and bond yields hitting its ceiling. The Bank of Japan is under duress, having to defend a policy the rest of the world is quickly moving on from. In other words, the rest of the world's tightening, Japan is still easing, and that's causing Japan to break because they're going against the flow. It was okay for Japan to be in stagflation when the rest of the world was in a growth cycle. When the rest of the world tightens, guess what happens? Japan cracks. That was predictable. I predicted it about 10 years ago in an article at Seeking Alpha, and 10 years later, guess what? It's coming true. In the clearest warning yet on the yen's weakness, Bank of Japan Governor Haruhiko Kuroda, 77, said Monday that the recent abrupt slide of the currency is bad for the economy, while the central bank reinforced efforts to keep a lid on yields. Still, the yen fell 0.6% to 135.19 per the dollar, the lowest since 1998. That would be, ladies and gentlemen, the lowest in 24 years, 2.5 decades. The downward pressure on the yen and slide in Japanese government bonds was triggered by a new wave of selling in global debt markets, led by treasuries, as investors shocked by Friday's U.S. inflation data priced in aggressive policy tightening by the Federal Reserve and sought refuge in the dollar. Quote, while Japanese authorities have stepped up warnings, there are few tools available to stop the momentum, said Akira Maruga, manager of currency products at 𝙎𝙊𝙇𝙍𝙍 Bank in Tokyo. The environment, he says, remains ripe for speculators to drive dollar yen higher. The yen fell almost 15% this year, the worst performing major currency, as the Bank of Japan keeps rates low to boost a sluggish economy, while U.S. yields surge on bets for continued Federal Reserve hikes, and so on and so forth. Japan is in trouble. I said Japan would break when the rest of the world couldn't bail them out. We go into a tightening cycle. What happens? Japan breaks. Called it about 9 or 10 years ago. I was right on that one. If you were reading my stuff at Seeking Alpha, of course, I wasn't on the channel at that point in time doing social media, but I was in print at a major US financial publication. Thank you, everybody, for joining the program. Remember, super chats are open for those of you that want to make a donation or ask a question. Guaranteed to answer if you do. Let's see if there are any questions in the chat. Let me see. I'm not seeing anything. I'm seeing lots of comments about California and Mexico. And no, oh, will Japan defend the yen, says Urban Sombrero. Yes, Urban Sombrero, I believe they have no choice but to defend the yen, because if they don't, their economy goes into the crapper, and given the amount of sheer debt that they have, it would cause Japan to go into a very severe, possibly worse than the Great Depression style of economic crash. So they're going to have to, the question is, will they be able to, in light of the tightening that's going on across the world, including the European Central Banks raising rates for the first time in 11 years. That's right. The European Central Bank is also raising rates for the first time in 11 years. This is more than just a cyclical downturn, people. The central banks are indicating, and the economic data is showing around the world, that we're in a severe recession. They haven't officially called it yet, but all of the data I showed you on this program, showed and read to you, indicates that we're in a severe recession already. Every indicator is pointing in that direction. I have one more article for you, ladies and gentlemen, today that I'm going to share. And that is, well, not an article, it's a chart that I put out. I was doing some nice friendly interaction with the Bitcoin folks and the crypto folks on Twitter the last few days, because I constantly, as a quote unquote gold silver guy, get trolled. I wanted to point out before I narrate this chart and talk about this chart that I started in real estate. I had a bunch of licenses in the financial industry. I've day traded currencies. I own Bitcoin mining machines. So no, I'm not a newbie when it comes to things other than gold and silver. That being said, I view Bitcoin in its current iteration as a speculative asset, not as a currency, and certainly not as money like gold and silver are. Changes need to be made to change that situation for Bitcoin. It's possible. I don't think the Bitcoin maximalists and the cultists in the Bitcoin world want that to happen. So I don't think the Bitcoin is going to be currency anytime soon, but there is a path to currency for Bitcoin, a competing currency, if changes are made. See my Twitter comments for how I think that needs to occur, and also my recent interview with Kurt Wuckert of CoinGeek, where we talk about that. Now on to the chart I'm showing on screen and what I posted to Twitter. This is gold over Bitcoin. In other words, if the chart is rising, gold is beating Bitcoin. And that's exactly what we see happening. This is a year-to-date chart. Gold is up over Bitcoin, but sharply since the very beginning of May. There was a big uptick from the early May, about the 2nd or 3rd, to about the 14th or 15th, and then a huge uptick with the absolute cratering of not only Bitcoin, but the rest of the cryptocurrency complex the last several days, where we have a near vertical, almost completely vertical spike in the value of gold as measured in Bitcoin, meaning gold is beating the pants off of Bitcoin when the market is panicking. Why do I show you this chart? Well, 2 reasons. One, because everybody says, Rob, be popular on social media, you need to talk Bitcoin. Okay, mission accomplished. I talk Bitcoin. But secondly, I bring it up because Bitcoin is not acting as a safe haven. It's not acting as money. It's acting as a speculative asset. I'm not just ragging on Bitcoin. Again, like I said, I own Bitcoin mining machines as a speculative asset. It would help me certainly financially if they went up. I have predicted the Bitcoin will probably go up to 80,000 on its next upward trajectory, probably when the Fed starts easing again. That being said, Bitcoin right now is not money. What does it have to do to become money? Well, you're going to have to go to my Twitter channel and look at Twitter, and you'll see I outlined it very succinctly, to which the Bitcoin maximalists made fun of me, but that's okay. It's friendly banter. And again, I don't hate on Bitcoin. I'm just showing what's going on right now with the data and the charts. I hope, for the sake of people that own Bitcoin and for the miners like me, that they make the changes to Bitcoin that need to occur for it to be a competing currency, because I ultimately believe gold is the ultimate monetary instrument, silver to a somewhat lesser degree because it's been so industrialized, but I'll take silver as well. But I do want any competing currency to the pure fiats, because that helps get rid of these stupid and ineffective and downright dangerous central banks. So please go fix the Bitcoin algorithm, release or expand the block size, do the other things we need to do so we can continue to have Bitcoin competing against the US dollar. Anything we can get competing against the US dollar is good for us in the long run. Thank you for the contribution. Deeps, he asked a question, how will emerging markets do when and if the USD crashes? Well, right now the emerging markets are in chaos because they've had inflation exported to them over the years, and as the dollar comes under trouble as the global reserve currency, the dollar is going to be stronger compared to everything else. You can see this in the DXY. That doesn't mean the dollar is doing well overall over time when compared to the price of real goods and or gold. It just means it's the best of the crappy currencies. So the rest of the currencies are already in trouble. And I think the emerging markets, when the dollar finally crashes, that could actually be bullish for emerging markets, however, because it means they'll finally be released from this Bretton Woods era dollar dominant system, especially since 1971, when we removed the dollar gold peg, and before in the 60s, I believe, we removed the dollar redeemability in silver, for which JFK wanted to restore, but well, alas, he was shot before he was able to make that happen. But I do think, getting back to the original point, the emerging markets will do better when the dollar is no longer the world reserve currency. I think that they will now not have to accept exported inflation from the US. Their goods will become more valuable in their currencies, and we'll have more competing currencies. I think that's probably what's going to happen. But right now, the emerging markets are taking it in the shorts as long as the current dollar system is in place. That's a summary. But again, my thoughts on that. Thank you so much, Deeps, for the contribution and the question. Love you very much for that. Any other comments or any other questions in the comments? Comment by Helen Stryker. Wow, losing mining a Bitcoin. I hope it goes back up soon. Yeah, I am, but that's okay. I know Bitcoin is an extremely speculative asset. I made it with discretionary income. It's not going to break me if I lose every dollar of it. But again, I made that on the completely speculative thought that Bitcoin's going to go up at least one more time. And if the developers fix it, it could potentially stay up as a competing currency. But I do think it's going to spike at least one more time, just like the rest of the markets will when we have our crack up boom. That's what I'm banking on anyway. We'll see if I'm correct. I could lose it all. We're going to see. But it's okay because I got gold, silver, and land in my portfolio. And those are my protections. So I can speculate a little bit. John MG, what's your thoughts on what's going on in Japan? I did just mention that they were in stagflation. They had the most accommodative central bank policy of any of the central banks over the last 2 to 3 decades. The rest of the world supported that, which allowed Japan to get away with it. Japan also monetized its own debt for a long time. Now the rest of the world is tightening and Japan is in still an easing cycle. Japan is getting it because who's out there to bail them out? Basically no one. And the only one that can do it is their own central bank. And eventually that system cracks. History has been clear on that. I also think they continue to have some energy challenges. And Japan, being a relatively small island nation, also has challenges with manufacturing, food, energy imports, stuff like that. So what's going on in Russia, Ukraine is affecting Japan in terms of oil, energy, rising inflation, availability of wheat and other goods that Japan takes advantage of. I think Japan's in a really bad spot. Russia, Ukraine came at a horrible time for Japan, given their years of easing and their central bank policy. And now the rest of the world's tightening, or the biggest central banks in the world are tightening. That's going to make, basically Japan has no allies monetarily at this moment. They're going to feel a lot of pain, and probably faster than the rest of the world. I think Europe will probably be next. And then US, this is coming to the US. Thank you everybody for joining the chat. We have about 239 in the chat right now. The rest of the time, I'm basically just going to make some general commentary and also talk about some things you guys may want to know about. I wanted to let you know that we are starting to do podcasts, or what Twitter calls spaces, on Twitter. And what that means is we're going to do audio every Thursday morning, 9 a.m. Central Time. That's right. Every Thursday, 9 a.m. Central Time, I'm going to have what I call a Let It All Hang Loose audio podcast on Twitter Spaces. My understanding is those podcasts are safe for about 30 days. We will eventually, when I get the technology set up correctly in my studio, also record that to an MP3 file, which we'll put out over our existing podcast on Spotify and on Google, and eventually we'll get it on Apple as well if I can get my Apple account working. So what does that mean? It means you're going to get me unfiltered. I'm not just going to cover gold, silver. I'll cover anything I want, and probably about a 30-minute to 45-minute broadcast on Twitter Spaces every Thursday morning, 9 a.m. Central Time, and we'll get that out into the podcast distribution as well. It'll be a chance for me to tell you what I think about a lot of things and also take questions. For our Twitter audience, why am I doing this for Twitter? Well, to be honest with you, our Twitter audience is growing very fast. It's our fastest growing audience, and I wanted to edify that by putting some additional content out for those guys that are there. A lot of you on the YouTube channel, also on Twitter. So if you are, you can follow me over there. And if you haven't subscribed to Twitter and you're on YouTube, go over to our Twitter channel, Gold, Silver, Pros, and you can subscribe to Twitter there, and you'll be notified when those Spaces broadcasts come out. Those will be live. And thank you, Danny, for putting the link to that in the chat right there for everybody. One other quickie announcement I wanted to make before I go back to questions is, and I got to share a screen for this one, is our precious metals dealer of choice, of course, is in at ARC Silver. If you want to buy silver and gold cheaper than anybody else on the planet, you go to 𝙎𝙊𝙇𝙍𝙍. You click right here on this little button, Precious Metals Deals, and you click on the link under ARC that says Access Deals. You'll get this nice little form that allows you to put in your personal information. Make sure that you whitelist this email address, invest@arcsilver.com, invest@arcsilver.com. Whitelist that so it doesn't go to your spam folder. And you may also get a text from Ian from this phone number. If you get it from that phone number, it's him. Please respond, and he will get you the information. Now, what does he have for sale? He always has 1,000-ounce COMEX bars for anywhere between $1.29 and $1.45 over spot. Right now, I think it's $1.29 as advertised on this website. As well, you get the special only here with Gold Silver Pros of Kennedy 40% halves at $1.29 over spot, which is one of the cheapest ways you can get silver on the planet. And it is constitutional silver, which is great because it means if you need to, people will recognize it and easily trade it. It's a government stamped coin at the lowest premium of any of the government stamped coins you're going to find. He beats prices across the internet for any of the other providers. He has other silver and gold deals. He only brings you the silver and gold he can get at the cheapest price. You simply have to email him, ask him what he has. But I can pretty much guarantee he's going to beat anybody else in the market. He's going to beat the big guys. He's going to beat the small guys. He's going to beat them all. And you can only get those deals here exclusively through Gold, Silver, Pros. All right, the poll. We're going to end the poll. What does the Fed rate hike look like tomorrow? 43% say 50 basis points. The original Fed expectation from last month. The updated expectation from the market expecting the Fed to hike 75 basis points is 49%, about half. And then 8% of you, tongue-in-cheek, answered the Powell grudge match with Yellen, which actually I would pay to see. If they put that on pay-per-view, I'd love it. I think it'd be a lot of fun. Thank you so much, everybody, for joining. I'm looking for questions in the chat. I'm not ready to wrap this bad boy up just yet. Oh, Abracadabra said, didn't Uganda just fund trillions of dollars worth of gold or find trillions of dollars worth of gold? I don't know. I haven't seen that article on any of the traditional gold or silver outlets. If anybody knows if Uganda actually confirmed found trillions of dollars worth of gold somewhere in Uganda, please let us know and send me the link, robert@goldsilverpros.com, and I'll put it on the program. Personally, when I was trolling through the different gold and silver and regular news sites today, I didn't see that mentioned. I'll go back and look and see if there's anything to it. If they did, wow, that would really change things in the gold market for sure. Scott Jane, I'm going to say, may I please have some more 1636 per ounce gold? You can, although I don't think the derivative markets are going to get down there. I think we're about to hit another major leg up in the gold and silver cycle. Now, I wanted to make this point for those of you worried about the gold and silver sell-off that we had the last few days, especially. Gold and silver are doing so much better than anything else in the market year to date that's been selling off. So they're doing their job. They're holding more value than everything else. They are in a little bit of a down cycle, but this is normal in a deep sell-off when you have a 20% correction. Gold and silver tend to correct to the upside in the past when this has happened. No guarantee of future results, but that's what we would expect to happen. They're still the safe havens. I think gold and silver pop somewhere in the second half of this year. It tends to be a couple of month lag before that happens. So we'll get the Fed announcement tomorrow. We'll have some more bearishness in a month or two. We'll have gold and silver pop, possibly sooner, but we'll have gold and silver pop. What has to happen is all the liquidity the market needs to cover margin calls and things like that needs to work its way through the system. And then when the money comes back in the system, it goes into safe haven assets first, which would be gold, silver. I also expect Bitcoin and some of the other cryptos to get a bid as well. Expect those to go up. That is my prediction. How about some Canadian maple leafs with 149 premium? I don't know if Ian has those. 149 premium is super cheap on a government minted coin, but you can reach out to him and see what he can get you. He'll get you the best deal available on those, whatever it is. Grendel Snap has a comment. Powell has a height and reach advantage, but Yellen has a low center of gravity and no brain to stun. That's an awesome comment. Thank you, Grendel Snap. Yeah, I tend to think Powell would probably win the grudge match, but you're right. Yellen is short, as a lower center of gravity, and probably more of the twit of the two, more of the clown of the two. So you're right. She may win just based on those factors. Oh, article on NASDAQ. Thank you for putting that in the chat. Abracadabra, I'll look that up. 31 million ounces, million ounce tons found in exploration. We'll look up that article. Thanks for putting that out there for us. I appreciate. I have a sharp audience. If I see that article, I definitely will cover that on the program, and we'll put it out over Twitter. All right, guys, I think that may do it. I don't see any other questions in the chat. We've been going for about 40 minutes. That's enough on these live streams. I'm here to answer your questions and to present you the data. And I think that we have done that today. Thank you for answering the poll. Thank you guys for staying tuned. Just a recap for all of those that are getting here late. We talked about all the recession indicators that are coming: inflation, interest rates, bond markets, stock markets, oil prices, monetary aggregates, M2 and TMS, which is the Austrian economist version of that. We talked about Japan breaking. We talked about gold doing much better than Bitcoin this year, although I expect both to continue to rise throughout the year. I think gold will get the bid first, and then Bitcoin will follow. The rest of cryptos will follow. That's my prediction. We'll see what happens. Also talked about big gold find potentially in Uganda. Thank you, Abracadabra, for putting that in the chat. We'll go look that up. And my expectation that I think gold and even Bitcoin will recover later in the year, although gold is the more stable and more proven of the asset classes. Thank you, everybody, for joining the program. I appreciate it. Until next time, this is Rob Kientz of 𝙂𝙊𝙇𝙀. This is Cowboy Metals Live. We do it every Tuesday at 5:30 p.m. Central Time, and we broadcast from a great state of Texas, where we take no bullshit. You get the facts here and nothing but the facts, with a little bit of fun commentary to go with it. Appreciate you guys supporting the channel. Love you guys. Stay tuned. Thursday, we're going to have Mr. Dave Kranzler, one of your favorite guests from Investment Research Dynamics, on the program. And I've got some other special treats for you coming in the next 2 weeks. Some bigger name guests are coming, bigger name guests than me, I should say, are coming to the program. Stay tuned for that. You guys are going to love it, including a first-time guest who'd never been on the program, but I know you guys are going to love. That's coming in the next week or two. We'll get it scheduled. Thank you, everybody, so much for supporting the program. Remember to subscribe to us on YouTube, Twitter. Go to the website, order your gold and silver from Mark Silver, and we will see you next time.